I don't know that anybody should listen to me, but what I got to offer is about 10 years of experience. If you fast forward to today, I'm a GP in about 1,200 doors, about $300 million of assets under management. Got my started as a limited partner, and really my story goes all the way back about 10 years ago when I decided I needed to get out of the corporate world, and I set about a very strategic strategy to find another income source. And for me, that was real estate. Investing is understanding the risks and knowingly going into them. Otherwise, you're just throwing money at an object and you're speculating. And so there's a difference between investing and speculating.
This is a marriage. It's a marriage for the next 3, 5, 7, 10 years, especially if it goes wrong. It is a marriage. And so being able to approach it with that same value set, that same expectation, that same level of conversations.
As one of my mentors said, partners are like a marriage. You can get into them very easy and inexpensively, but to get out of them are very expensive and heartbreaking. It's a relationship business. You have a bad relationship, it sticks with you. You're going to pay for it, so try to minimize.
But it's a marathon, it's not a sprint. If you have a bad reputation in the field, it will follow you. You need to be able to set up solid branding, relationships, ethics, and integrity in order to have good joint ventures and successful projects.
I am Christina Suter, and this is the Real Estate Breakthrough Show, where we talk about the reality of real estate, the mindset you need in order to face the reality of what it is, and tips and tricks to get you moving forward in investing. I am your host, Christina Suter.
Hey you, this is Christina Suter with Real Estate Breakthrough, and I have Randy. Oh, Randy, how do I say your last name?
Langenderfer
with me here in the studio. Randy, I am excited. Why don't you give people the bottom line history? Why should they listen to you? Because I know you're an expert in the field, but they don't know that yet.
Christina, first of all, let me just say thanks for being on the show today. It's really a pleasure, and I enjoy these times, and so thank you very much. And so I don't know that anybody should listen to me, but what I got to offer is about 10 years of experience. If you fast forward to today, I'm a GP in about 1,200 doors, about $300 million of assets under management. I got my started as a limited partner, and really my story goes all the way back about 10 years ago when I decided I needed to get out of the corporate world, and I set about a very strategic strategy to find another income source. And for me, that was real estate. So that's my nutshell in 30 seconds.
Why leave a corporate job for real estate? Why use real estate to break through to your financial freedom?
I did that. So 10 years ago, I was working for a private equity company and realized that was a short fuse, and I was afraid I was going to get fired because of not performance issues, but because of just the economics. That's when I found real estate. And I just fell in love with it. So I did. I started educating myself, large educational effort. I started investing my own money. I waited about 5 years before I did my first GP deal where I actually bought the asset. And I set upon a date 10 years ago that happened last April of 23, when I decided I was going to walk away and do this full time because I want to, not because I have to.
That is the beauty of investing in real estate, in my opinion. It fits two bills. One, it brings you income, whether you're doing it actively or passively. It brings you income so that you get passive income streams or income streams that you have to work less hard for. Let's put it that way. But it also, if you want to not be in corporate America, you've got the heart of an entrepreneur. The value of real estate is that that heart of an entrepreneur serves you. You might work harder. You might even work longer hours. You might be even more challenged. But because you're being able to be an entrepreneur, a leader in your own financial freedom, and a leader in real estate, it brings up that heart that is enlivened, that is encouraged, that is supported, and going, I am creating my future. I am creating my business model. I am choosing.
I'm just like a lot of people though, Christina. I got started, I did a graduate thesis years ago on entrepreneurship. So I've had it in my blood. I got busy with life and kids and raising a family and climbing the corporate ladder and all those things. And then I just realized that, I'm not doing anything for myself. It's all for the man, as I call it. And I just decided that I wanted to work late in life. And so I was going to work late in life, and that's okay too, if that's what you want to do. And I just decided I wanted to do it for myself. So here I am.
Yes, it makes perfect sense. What do you feel like in your history prepared you for being able to either do that transition or just be successful in real estate today?
What I've done that helped prepare me, one is I'm different kinds of and real estate people, but I'm on the analytical type. I'm an MBA in finance and a CPA. And so
yep.
I love a good spreadsheet. Most people don't. but I'm kind of a nerd at that. As my wife says, go hang out with all your nerd friends, Randy. And I do. And be happy. She'd tell me, go hang out with them and be happy. So I'm a very analytical type. So what prepared me, one was, in the corporate world, I worked in the risk mitigation areas, in corporate areas. And so it's all about, for me, it's investing is understanding the risk and knowingly going into them. Otherwise, you're just throwing money at an object and you're speculating. And so there's a difference between investing and speculating. So I think my analytical brain helps me. I think it helps me to reduce risk when I'm looking at deals, and I'm conservative. And so I've been pretty successful over 10 years where I've made some decent money. And I hope there's a lot more to come in the rest of my life.
I'm a great believer, especially since real estate is so entrepreneurial based, that the secret sauce of your company usually comes out of the skill set of the leader of that company. So since you are the one that is the leader in your company, what would you say the secret sauce of your company is? Probably comes someplace out of the fact that you're a good old-fashioned geek that's good in analytics, which serves in real estate beautifully, in my opinion. So what's the secret sauce of your company?
I think the secret sauce too is also not just the analytics, but finding good partners to work with. Real estate's a team sport. And I think my corporate world taught me that, how to work with people and have project teams for different things. Because, in multifamily, you're getting married to somebody for 3, 5, 7 years. So you better enjoy their company. And I think I've had the privilege of partnering with some really great people that I've enjoyed their company with. And it's not adversarial or, where we're at each other's throats, because it is a team sport. And you have to be able to work with people and communicate effectively with investors. And I think those all came from my corporate world of risk mitigation.
So joint ventures, it's a current topic in and among a lot of people on my side of the world right now in the Los Angeles, Pasadena area. And tell me a little bit about how you go about setting up joint ventures and finding partners in a way that is successful for you.
I wish there was a 12-step process.
Me too. Me too. I wish there was. If there was, tell me, please.
I was going to say, if there was, I'd be out in the circuit consulting and talking a lot about it. But simply put, for me, as you would say, the bottom line.
Okay.
It's about old-fashioned networking and bootstrapping. It's talking to a lot of people. Deals aren't made in my office looking at spreadsheets. Deals are made out looking at properties and networking at conferences and finding people. And, after you've had a little bit of success, deals start coming to you too. And you have the privilege of cherry picking which ones you like and which ones you don't. But starting out, I worked very hard at finding people that were like-minded and had a skill set differentiating than mine. I don't want to partner with another analytical type. I want to partner with somebody that's good at marketing or somebody that's good at social media or et cetera, et cetera.
Being able to realize that early, I think, is particularly important because, even myself, my early partners, I would say, mimicked me in a way. And because I get along with them so well, woohoo! We're both busy, we're both chatty, we're both good at, I'm pretty good at the nerd stuff, but at the same time, I'm also an extrovert. And so I will often relate well with other extroverts. Instead of really looking for somebody who's really grounded, simple, straightforward, and they're thinking good at project management and consistency and being able to check a box day after day after day, because that would be my counterbalance, right? Where I can run the numbers and I can read the contracts, that's not a problem for me. But that sheer consistency is not my biggest strength. Just to own it.
Well, and the fact that you can own it is something that very few people can do. To own we can't be great at everything.
No.
And nor am I by a stretch of the imagination, but knowing what your strengths are and the people that you're going to work best with, right? In a marriage, opposites attract. I don't know what they do in business.
No, but I think you're right. And you said it early, which is two things. I think you said that were really important. One is that this is a marriage. It's a marriage for the next 3, 5, 7, 10 years, especially if it goes wrong. It is a marriage. And so being able to approach it with that same value set, that same expectation, that same level of conversations, I remember having conversations with my early boyfriends about like deal breakers, right? As women, we talk about deal breakers. Did you ask them the deal breaker questions? Did you say, does he want to have kids or not? Did you ask him if he wants to get married or not? Those are our deal breaker questions. Like as women, you learn to ask deal breaker questions. It's the same in setting up a partnership. You want to be able to set up questions that you know are deal breakers for you in joint ventures, right? And I think people don't think about that. They don't preset their joint venture questions.
As one of my mentors said, partners are like a marriage. You can get into them very easy and inexpensively, but to get out of them are very expensive and heartbreaking. So.
Yeah, no, it's true. That's accurate. And the other thing you said I thought that was really brilliant and a good bottom line was deals aren't made by sitting in your office with an Excel spreadsheet. Like, it just is true. It doesn't matter how good you are at that. You've got to be able to establish yourself or have somebody who is your partner establish the brand outside of your office, in the conferences, in the meetups, in social media.
Talking to brokers, talking to investors. I mean, I just spent the last 2 hours talking to investors and about everything and anything. Deals gone bad, deals gone good, and everything in between. So it requires a lot of time. And that many of the educators are out there and they put, get rich, get quick schemes out there. I don't think so. I think it's the old fashioned way of blocking and tackling, and it's a relationship business. You have a bad relationship, it sticks with you. You're going to pay for it. So try to minimize them because you don't want too many of them.
Again, very wise words. Truly. I mean, I think it's accurate. Been in the field for over 35 years. I stopped counting at 35 years. I've been in the field over 35 years, and I would definitely say that this is a marathon. They do it again. It's a cliche, but it's a marathon. It's not a sprint. If you have a bad reputation in the field, it will follow you. You need to be able to set up solid branding, relationships, ethics, and integrity in order to have good joint ventures and successful projects.
Sure, you can think of 2 to 3 people off the top of your head that you would never work with again, maybe because you did and they were bad experiences, and you learn from those. So you're never going to avoid them 100%, but you try to minimize them. But boy, there are a lot of them out there because there's so many people in the industry today. And if you're younger, new to the field, you may not have as much experience to differentiate those, but talk to people. It's a small enough space that if you ask 10 people around the country who Randy Langenderfer is, you'd probably get a response from somebody. He's a nice guy, he's a good guy, or he's a bad guy, whatever.
Right. And he's integrous. Know, like, and trust. Know, like, and trust. You need to be able to trust him.
And that is so understated, though. I mean,
jump on it. Go for it. Tell me, Randy.
It is so understated because I just got off a call with an investor that was given bad news to, and it is so understated because he doesn't hate me, but it was difficult conversation, but it was okay because he knew, liked, and trust me, and therefore it's better. And it is just such a relationship business, especially when you start taking on other people's money.
Yeah,
you're asking them to invest with you.
Yeah,
that's a big deal. Even if you're rich. They may be able to lose it, but they don't want to lose it, and nobody does. So cherish those relationships, nurture them, whatever they are. Keep really good notes on people, what motivates them, what kind of deals they like, what kind of deals they don't like, so you can remember when you're aged like me, when you get on the phone with them, what the talking points are.
Yeah, no, it makes sense. And it's a good joke, by the way. Randy and I, just to reveal the jokes between Randy and I to the listeners, like Randy and I, when we got on the phone, we went, did we remember this right? Because neither one of us are young enough to make sure that we knew that we remembered we remembered our previous phone call, what time we were supposed to meet. Like, we're both like, yeah, well, we're older, but hey, if it's on the calendar, we're good.
That is the main point. It's on the calendar.
Yeah, that's exactly what happened to me this morning too. I'm like, hey guys, reach out to the production team. Hey guys, this is on my calendar. Is this real? What? So. And
I generally try to do a little research before I can jump on the call. I was just on the call before this, so I couldn't.
It's all good. But you touched on this just a minute ago, which is right now, what is your industry facing? I think that's particularly important because just to timestamp this particular podcast, it's July of 2024, and we have seen the Fed increase interest rates aggressively, starting, I think it was in, oh my God, is it March or May, right, of 2023? So we've been at this high interest rate environment. I invested in the 80s, so high is a, I don't know what you call it. Objective. Relative. Thank you. I was trying to think of subjective, relative term. So it's not really that high given long-term standards, but it is high given the environment we came off of. And the Fed intentionally increased and ratcheted up the interest rate very, very quickly. I have my reasons as to why I think they did that. One of the reasons, which to just stick with the bottom line, is because they were looking to create slowing in industries, in the economy as a whole. So they ratcheted it quickly, the quickest they've ever done, even quicker than they did in the 80s, in order to create a slowing in the economy. That has affected the multifamily market. So right now, what is your industry facing, given that we're still in this higher interest rate environment?
Yeah, we're facing a lot of headwinds right now because of all the liquidity that was dumped in the market through COVID. And you're right, I agree with you. The Fed intentionally wanted to slow the economy down and slow it down and pause it somewhat so that people would stop spending. And they did a pretty good job at it by raising interest rates 500 basis points over about 18 months. And so we're forced with that today. And to me, as a multifamily syndicator, that is the biggest headwind is being able to underwrite good deals today at higher interest rates and living with the variable rate debt. If you bought a property in 2021 or 22, you had variable rate debt. It was the only way deals were getting done. And so those are challenged today with most people bought a rate cap policy, and those are challenged with getting those rate cap renewals and trying to find a way to refinance those properties and keeping investors whole and continue to do deals. And so I love the people that had the foresight to only do fixed rate debt and took a 2-year pause. Mm-hmm. But I also don't know that that's long term. I would say I'm a buyer in all markets, up, down, and sideways. You just buy very differently. Who could have predicted 500 basis points in 18 months? If anybody,
it hasn't been in our history. Even in the 80s, it wasn't in our history. So it's hard to imagine the Fed would do. I mean, I understand why they did it when you look at the data and you look at the lag behind inflation. Right? Inflation had already, because of COVID, inflation had already moved up aggressively. They were almost 6 months to 8 months behind in being able to raise the interest rate, given their usual pattern of raising interest rates right on the tails of inflation. And therefore, inflation is going up and interest rates are going up. And you can see the chart with it almost like one right after the other. And here there was an active gap because they kept saying, "Oh no, it's COVID. It's artificial constraint in supply and distribution. Therefore, as soon as COVID is over, all this is going to change, and we don't want to disrupt the system for a temporary result." Well, it wasn't temporary. There was a lot of freaking cash in the system. Excuse my language.
Still is,
right? Okay, so therefore, that's my little spiel. So yes, so then who could anticipate 500 basis points in 18 months?
I mean, it's just unprecedented, and no matter how good you are at risk mitigation, everybody's struggling with it. And so, the only question is does the Fed come down, when they come down, and how fast they come down? I've heard it said that anywhere between, from the first rate hike to the first decrease, is anywhere from 24 to 35 months, something, if I remember correctly. So we're right in that window towards the end of this year when rates should start coming down. And it's just a matter of whether you believe they're going to come down slowly or rapidly. And I guess I'm probably in the camp that they're going to come down slowly over an extended period, but at least they're coming down. They're headed the right direction.
Yeah.
I don't know that we ever see 4% again in mortgages, but my first mortgage as a primary residence was 11% FHA loan, and I was ecstatic to get it. So you're right that long term
80s, early 90s.
Yep. And I was ecstatic to get that 11% FHA loan. So historically, they're probably closer to where they need to be than the last 10 years where they've been artificially low, and everybody's been borrowing like a drunken sailor.
So what do you feel like, is this a good time for continuing to do multifamily deals? And if so, what would be your constraints around that, being the analytic that you are?
So let me tell you about a couple deals I've just recently done. Well, last year I did one. I'm in Texas. Didn't tell the audience I'm in Houston, Texas, and so I guess I would say you do deals all the time. You just have to do them differently. The one we did in Texas last year, big property with a couple of partners, fixed rate debt, and a tax abatement strategy. So anybody that knows Texas, real estate taxes is huge.
Yep.
If you can get a tax abatement where we pay zero real estate tax, that's a huge differentiator.
Right, it is huge. I mean, people. Sorry, I want to emphasize how huge because I don't think the listeners understand that real estate tax abatement. When you're talking about tax returns or property taxes in Texas, 2%, 2.5%, 2.8.
It varies, but yeah.
Right, it varies based on county. So if you literally say, hey, guess what? The moment we transition this building to a tax abatement structure, you literally have increased rents or decreased, right, and increased NOI by potentially up to 2%, 2.5%, just out the gate.
Well, this happened to be a big deal, but day one, we took $2 million out of expenses, and that falls right through to the NOI.
Right.
Day one. So different kind of deal. I haven't done any quote value adds deals lately. The one I'm just getting done doing is a build to rent project in North Dallas with another group of people. So I think that one is really different and I like the build to rent because it's construction, because the build to rent has a different tenant model. They tend to stay longer. A small rent bump they tend to be families, younger families. Their average tenant is like 3.5 people, and these are all built specifically for 3 bedrooms, 2 baths, a car, a garage, a porch, et cetera, a small yard. So very different than your normal apartment complex.
No, totally. Very different. If you're doing single family built to rent, even townhome built to rent, it's very different than an apartment complex, especially when you're doing the higher bedrooms. Minimum of 2 bedroom, 2 bath, preferably 3 bedroom, 2 bath. Get families to move in. They stay much longer. I don't know what the actual average is out in Texas, but I know my observation in my own units has been you'll have in a 1 bedroom, 1 bath or 2 bedroom, 1 bath, they'll stay 3 years. But as soon as you get up above that, then you start getting into 3 to 5 years easily.
And you get, either a dual incomes family that wants an office at home, or you have a young family that's got a kid or a child or 2 at home. And so it is just a different tenant population base. They tend to take care of the property a little bit better. And this is just in northern part of Dallas where the growth is just going bonkers. And so I'm excited about that one. But to your point, different kinds of projects, I think, than the now typical value add deal. And I'm not saying anything bad about value add because they're all still good. That's why I say you just buy differently in different markets.
Well, developing is definitely different than buying value add. That's definitely a different strategy, even though it's still inside the residential niche and the residential area. So if we have a recession coming up, do you think we're having a recession that's going to show up?
Oh, I don't know. I'm not that smart. I could argue we're in one because when people look at their spendable funds, it's dwindling. And I even see that when I go to the pump or the grocery store.
Right.
And I don't go to the grocery store very often. I went recently with my wife.
That's the actual ultimate question I'm getting to is how are you as a company going to be prepared for what's the financial future of this next year to 18 months?
And are you going to see, slowing down? A couple of my properties here in Houston, slowing down. We're not seeing the rent bumps that we saw. It's stagnated. It hasn't really fallen yet, but we're starting to see a lot of concessions in the market to get tenants in. That costs money to us as owners. I think I like the Texas market as it remains strong just due to the population growth and the income growth in Texas and the 4 major metro markets. So I tend to think we'll be okay. I don't see a major recession forthcoming. I'm not the brightest crayon in the box, but I don't see a major one coming. I think if it happens, it's going to be fairly moderate. Nothing like we saw in 08 and 09, that way that you and I lived through.
You definitely lived through that. I don't think we're going to see it either. And I was just looking the other day, and I think it's 90% of the MSAs are still seeing upturns as of the first half of 2024. So, because that's the data that just came out. So as of previous to June of 2024. And that's amazing to me that in this quote unquote high interest rate environment with the intention of being able to cut and slow down the economics, that residential real estate continues to act alone as a niche inside of the economy, primarily, I think, because of supply and demand and the lack of supply, lack of pure housing, which is why I think development, like you're doing, is a really good idea in one, coming off of COVID, two, in this downturn market, three, even though rents are stagnant, you have this longer trajectory, this longer timeline before you even release the units on the market. And they're new. So they bring premium rents to begin with.
They bring premium rents, and everybody in Texas, probably everybody in the country, loves a new product. You know, who doesn't want to be the first one to live in a new product? And that's a keeper. And all the other reasons you just stated, this, and it's in northern Dallas where the homes around it are selling for $600,000-$800,000. And so if you get in a BTR, you know, where you're paying maybe $3,000 a month rent, that's a much lower price point, and people can do that much easier than coming up with a 20% down payment on $800K.
Yeah. It's interesting to me. Dallas years ago, I think we don't have to talk about this for too long, but Dallas years ago, when Dallas first became found in my real estate circle here in California, that was probably over 25 years ago. And I must say, Dallas has had the longest run in its reputation in California as a good place to invest than I've seen in any other state.
I'm very aware of the other Texas markets, Houston, Austin, San Antonio.
Yeah.
You are right. It tends to have that bulletproof image. I don't know that it's bulletproof. I don't think it's bulletproof.
I've invested in Arlington, Texas, so I know it's not bulletproof, but at the same time, it's go ahead, keep talking. But it has its weaknesses. But if you know its weaknesses, like
but most people generally, I'll say from California or any other place, would rather go Austin and Dallas. I don't know why they don't like Houston or San Antonio, but that they tend to be, we're in the bottom half, and Austin and Dallas seem to be the place. And Houston has, though, some of the highest rents in the nation for where we are. And it is just, you know, we're bringing on every year, the average absorption is like 15,000 units in Houston. That's crazy. But they keep coming every year, and they keep getting absorbed.
That's amazing. So I know you've got an upcoming course coming, right? Like, are you covering this stuff in your upcoming course? Are you covering, I know you're covering due diligence because of your analytics, but you know, what's in there as far as the coursework? What is it you feel like people really need to know to even be able to do well?
Yeah, so thank you. And my partner and I have developed an educational course to help people find how to buy multifamily properties. And, you know, there are a ton of educational groups out there. So you may say, why'd you do that? But there are a lot of national ones out there, but we really think, I've been in several of the other ones, and we really try to differentiate as more of a personalized touch, a little more hand-holding. We're at a much lower economic point. But yeah, we have group calls. We have about 35 different online modules you go through at your own pace. And then we have group calls. And I think we talk about a little bit of everything. It's just a matter of where the student wants to go. And you get me or my partner versus somebody that's a coach. That's been designated as a coach by somebody else. And we're excited about it. And I don't have a large infrastructure, these guys. I don't have to have 1,000 students to provide value. I just want to do a handful. So,
you know, you talk about why would you put together coursework, and my experience has been that there's a point where you have spent so much time in the field developing your knowledge and an expertise. And maybe it's related to age, right? We're older as well. Like, I'm 55, and you know, I suspect you're around that. We'll just say you're around that age.
I got you beat.
Okay, well, fine. Just because you'll be beat there doesn't mean you don't in other places, babe.
I got you beat in terms of being older.
I figured. I figured that was
not younger.
Not younger. No, I figured you meant older too. That was still my response. So. But the point is that there's a point where giving it back forward, like teaching, is fulfilling. Like, that by itself is like, I've spent years putting together this knowledge base. I've developed through deals that went right and deals that went wrong, what it means to be able to do well, to manage it, which is why, you know, this show has mindset type stuff in it, being prepared for economic cycles in it. That's why I have those questions, is because it isn't just about the capacity to do your due diligence. It's about one's internal grit and one's determination and one's willingness to stay educated and current in your market. You kind of have to be able to do all three. You got to be good at due diligence. You got to be able to have a good grit and capacity to make good decisions. You need to stay up to date on economics, and you need to understand what's happening inside of your field in order to continue to be successful over the marathon that this is. So, there's a point where teaching and giving it back is a big part of the satisfaction.
Well, I'm sure that's why you're doing the podcast as much as anything is just to give back to the community. And if you think back, I'm sure I can think of many people that have built into my real estate education, and I am eternally grateful. Some I paid for, some I didn't pay for.
Right.
And to your point of it, it sounds corny or quirky, but it is about giving back. I hope the next generation and the next people can far exceed what I've done. And so if I can be any part of that, I'd love to do it, because the money's nice, but it's about also seeing the fulfillment of other people grow.
Yeah. And there's a deep value to that in life satisfaction, right? Erickson talks about stages of life. I think it's Erickson. Yeah, it's Erickson talks about stages of life, and like when you're in your 80s, you look back over your life and you decide you're either satisfied with what you did or you're not. You don't get to do it again. That's the whole point of asking the question at 80. And I want to be 80 years old and I want to be satisfied. I want to have been a professional investor. I want to have been a good parent, and I want to have been a good human being. And education and paying it forward is part of being a good human being.
Well, and the challenge is I'm getting off topic a little bit, but the challenge is to maintain that satisfaction at every season of life.
Yeah.
When you're in your 20s, 30s, 50s, 60s, 70s, don't wait till you get to be 80. But at the end of 80, I certainly understand the reflection point you're talking about.
Yeah.
But that's why I left the corporate world. It wasn't because I could use the money someplace, but it's personal satisfaction.
Personal satisfaction. And I think you're right. In every stage, I was just talking with somebody, one of my students, he was saying, oh, well, I'm tired every afternoon at 3:00 and da-da-da. And it might have sounded weird, but my answer to him was, how about you stop your day when you're feeling satisfied that you've done the work that you're content with? And he's like, wow, that's a whole nother way of looking at it. I went, yeah. Because if you're tired at 3:30, you sit down, you meditate, you take a nap, you have a snack. I mean, there are countries that have built in that 3:30 tiredness into their schedule. England has a snack. Spain has naps, right? So like literally
Asia has naps.
Asia has naps as well. I did not know that. I will add that to my list. So it's not like you're personally failing if you're tired at 3:30 in the afternoon, because it's clearly built in cultures, right? So it's not a personal thing to you. But the question is do you want to get up and live more of your day? And in England they do, and in Spain they do, and obviously in Asia they do. So they take a break and then they get back at the game until they're satisfied, not exhausted, not tired, not overwhelmed, not worked yourself to the bone, but satisfied. What does that mean to live a life that's satisfying?
And it's so different when you're satisfied for your own goals and objectives versus, I call it the man in the corporate world.
Yeah.
It's such a huge difference for me, a satisfaction that I don't have to have, fill out useless reports and review budgets and performance evaluations and all those things that I viewed as non-value add. But I love to talk to investors, and talking to you and others about real estate almost anytime, anywhere. So.
Right. Therefore, it's satisfying.
There you go.
Yeah. No, it is. It's when the conversation is something that you actually enjoy participating in, even if it is a tough conversation.
Right.
If you know it's going to lead you where you want to go, even those conversations can be satisfying. Tell me about a deal that went wrong, and tell it from a point of view of educating what you learned from it, because deals go right and they go wrong. There's no way to avoid deals going wrong. Everybody has deals that go wrong. I can go down a laundry list of people I know who I respect deeply in the field who've had deals that go wrong, including Rod Khleif, right?
Yep. And if you talk to somebody that says they haven't, anybody, run from them, because you're absolutely right. Everybody has had.
That's right. If they say they've never had a deal go wrong, run for the hills.
Because it's just either they're in the midst of it, or they're about to go into the midst of one, or they've had one. That's one of the three.
Rod Khleif, Neil Bawa, Bruce Norris, Zillow. Zillow had a huge, right? They were buying, I'm sure you heard the Zillow story, where they were buying based on their ARVs. They bought houses in order to prep them for rehab and sell. And they took a huge loss. I think over $300 million worth of book loss on their books because of the miscalculation they did. So even Zillow and Rod Khleif. So there you go. Okay, go ahead.
Joe Fairless, another one, puts him out there, and he's had some early failures. But I think the one I talk about the most is my first GP property. 2 months into the deal, the place caught fire. We had 28 units go down. We had property management that was just terrible. We ended up having to right the ship. I came over as basically the regional property manager, and I say cut my teeth as asset management or property management, and working a lot of hours trying to right the ship. Lessons learned were find a good property management company on real estate. It had a very positive ending in that we were able to double investors' money in 21 months. We sold it. Fast forward to today, I've got a couple assets that I'm working through the debt situation on. The outcome is not known yet, but heads down. We're spending a lot of time on it and trying to make sure we can navigate a soft landing.
One of the biggest skill sets in real estate, in my mind, is one's grit and integrity. Like we can be nerds all day long. We can be super smart. We can be, we can have a whole data team behind us. I mean, just look at the list of people I've just listed, right? There's no question that,
right.
Joe Fairless had a team behind him, that Zillow had a huge team behind him, that Rod Khleif is smart enough, that Bruce Norris is very smart. Lots of people who've had different skill sets, and they still have faced a difficulty. So it's not about whether you face a difficulty or not. It's really about your willingness to double down into your integrity and your grit to make that difficulty solved.
Grit, and to me, it's another one in there. I'll just throw in there is Christina, is communication. How you communicate. There are so many people I talk about that go radio silence when bad things happen.
Yeah, they do.
They bury their heads in the sand. Talk to your investors. Talk to the lenders. Talk to your tenants. Double down on communication.
Beautifully said. All right. Now, you promised me at the beginning of this conversation that you had a discount for my listeners. So you better pay up, dude.
Better pay.
Pay up, dude.
Well, hey, I mentioned to you that I had started this educational program.
Yep.
I had multifamily maestros. And so people can find it, multifamily maestros, it's all one word.com. And what I want to do is for your audience, anybody that's interested in that aspect, is to say that for $197, we're going to give you a 30-day trial where you can see the access to the online courses, and you can join our group calls and get a flavor for it to see if you want to go forward further. But $197 for 30 days, I think it's value. We'd love to have you. Contact me offline or go to that multifamilymaestros.com, and you can see it there, the opportunity.
All right, Randy, if somebody wants to get a hold of you directly outside of Multifamily Maestros, how do they do that?
I'm on all the social medias. LinkedIn, Facebook is the easiest way. My website is invest-ark, A-R-K, invest-ark, A-R-K.com. There's a contact me on there as well. Would love to chat with your audience, Christina, about real estate, because I enjoy it and I am a nerd.
I love it. Nerds do well. My daughter's a nerd. I keep telling her she's going to be great. All right. This is Christina Suter's Real Estate Breakthrough. So thank you so much for listening in today. We'll have another show for you in 2 weeks. And you can find me on all kinds of platforms: YouTube, Roku TV, iTunes, Spotify, lots of different places that you can find this information. If you're looking for me, you can find me at ChristinaSuter.com.